Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Kristi Ross joins us today from Chicago. She is co-founder, co-CEO, and president of tastytrade, an award-winning online financial media company, which also has its own subsidiary trading firm, Tastyworks. Previously, Kristi was CFO at Automated Trading Desk Specialists. She then served as CFO of Thinkorswim, where she led numerous mergers, acquisitions, and integrations. And a little over a decade ago, Kristi co-founded tastytrade, which was acquired in 2021 for over $1 billion by IG Group. During her time there, she also co-founded Doe, a visual front-end trading technology platform that became the base for launching an online brokerage firm within tastytrade called Tastyworks. Kristi, welcome to the show.
Thank you so much for having me on, Nick. I'm excited to be here.
It's so fun to turn the tables. I think it was probably 4 or 5 years ago I was on Bootstrapping. I know that you have a long-term history in hosting and interviewing folks. So this is a lot of fun for me.
Yeah.
So just to start off here, can you kind of give us a sense for your background and the early elements of your career before you got into trading?
Let's see, this started a very long time ago. I started out in finance and accounting, and a lot of the clients I worked on were trading firms, traders on the floor, prop firms, advisory firms. And Nick, from the first time I stepped on the trading floor, I said, this is where I need to be. The energy was absolutely infectious. And the sheer volume of sort of monetary exchange was really captivating to me. I became a CFO at age 25, and I have been in and around the trading and brokerage industry for over 30 years. I actually talk in decades now. So over 3 decades. I've been through over 40 mergers, acquisitions, capital raises, and startups in my career. As you mentioned, one of the most recent companies, certainly tastytrade, which we started in 2011. And there are 4 co-founders, myself, Tom Sosnoff. Tom is truly the visionary, and Scott Sheridan and Linwood Ma. So we've actually been together for over 20 years. But within tastytrade, we built 7 companies within our company over the past 11 years. Super fun. And as you mentioned, we sold to a public company out of London, IG Group, for over $1 billion. And if I were to sort of set the stage for where I am now, I actually self-directed trader and active angel investor myself, and very, very involved in the Chicago tech community and startup community. But also, I have since left IG. I'm still on for this next year or so, but negotiated my way out because I am ready for my next phase, which, cross my fingers, I will be announcing next year. But that transition and that leap was a big step away from something I am truly passionate about and believe in. And when you've been with people for, a couple decades, it's a little odd making that transition, but it's so fun. I'm full of energy and ready for this next endeavor.
I love it. You're the consummate founder, just constantly reinventing yourself. So, of course, I'm a Chicago-based venture capitalist. You, Tom, and the crew are legends here in Chicago. I happen to work and partner with many people that have traded both in the pits and through various online market makers and firms now. So I've heard the stories, but many people in the audience, whether it be based on age or just not being located here, don't quite understand the history of trading. So can you take us back to some of the early years in trading, sort of pre-Thinkorswim? How was trading done in the 80s and 90s? Can you talk about the pits and open outcry a bit and give us a little bit of the history?
Sure. And that does bring us way back to, let's say, the 80s. And that is when I first me stepping out of school, it was in the 90s. And so coming into Chicago, and as I mentioned just right in the beginning about that first step onto the trading floors, it was an incredible energy that was there. The open outcry, it was very physical. I didn't trade on the floor, but I was down there when I talked to our clients, and you needed to have a physical presence. There were a couple guys that were shorter that literally wore platform shoes just to gain an edge in the pits. It was interesting, but it was also a locker room. It was truly the boys' club, if you will. There were not many women that were on the trading floor. What I saw and participated in was sort of this shift that took place in decimalization when we went from fractions to decimals. And that transition was actually sort of an important part of the history of trading and technology. As we shifted away from the physical open outcry into more of the automated trading, there was a massive resistance, and rightfully so, to that shift in technology. I remember one of the deals that I went through. So at the time, I was the CFO of a company called Chicago Securities Group, and we did a deal with automated trading desks. And I remember going around talking to a number of different traders in New York, in Chicago, all over the place, different exchanges. And the massive resistance around them feeling like they were going to be dinosaurs, they were going to eventually be extinct, was very, very real. And yet I was coming in with a crazy amount of energy around, look at what this can do ultimately for the end customer and improve executions. Right?
Sure.
I mean, speed of execution and quality of execution and all of the different things that you could actually do with technology versus what you're going to do with a manual process. Anyway, so it truly evolved. Now, later in the 90s, so 1999, this is prior to me meeting Tom, because Tom had actually started, Tom Sosnoff, a co-founder, he and Scott Sheridan had actually started Thinkorswim. So they were on the trading floor in the options pit, in the OEX pit, and they saw an opportunity for bringing online trading to the retail investor. Now, Options Express was doing the same thing down the hall in the same building in Chicago. And that was probably our biggest competitor or most similar competitor at the time. But I joined only a couple of years after they were starting to get it off the ground. So they were still pretty small and they needed, I remember because TCV, Technology Crossover Ventures, out of Palo Alto, had invested in them. And they, I still remember they said to Tom told me this story. They looked at him and said, listen, you need a CFO. And they told Tom that he and Scott wouldn't know a CFO if it hit him in the face. They were looking for a CFO. I ended up becoming their CFO very early on and helped them grow the business. And we had gone through sort of 6 mergers and acquisitions in 6 years and ultimately were bought out by TD Ameritrade. But what was interesting during that time frame is online investing, particularly with derivatives. I mean, there just really weren't that many companies doing that, offering that. And sort of this shift to online trading and for the retail investor, you know, I remember picking up the phone and making my own.
Call your broker.
Call your broker, right? And they'd call me back with a quote and then they'd call me back with a fill.
In fractions, not decimals, right?
Exactly. And, you know, and that was years ago. That was certainly way prior to Thinkorswim. But that was the biggest transition, is being able to press the button yourself, having speed of execution be in fractions of a second and continuously improving over the years. And so that, I think, was one of the biggest changes and shifts in the industry, is when all of a sudden sort of that, you know, democratization of access to the public markets was made. While you hear a lot of companies today declaring that was happening in the late 90s, early, 2000s.
Kristi, aside from starting the brokerage, what was the other biggest shift in strategy in the early years? You know, what was the biggest epiphany or lesson that caused you either to pivot or expand or do something different?
Well, you've heard this a million times. You know this from companies you invest in. If something's not working, like, pull the plug and you got to move on pretty fast. Well, and so I'll go back to the very, very beginning, because there was a pretty big pivot even in the beginning, other than looking at we were going to do Squawk Box to adding full-on video. It was the type of content that we were producing. We came in thinking, okay, we need to really create something fun and we'll add a little bit of trading. So we had all these Second City comedians producing content about trading and just in general. So it was meant to be more entertaining. And we really listened to our customers and they wanted more trading. And so our accessibility as CEOs and the company as a whole to our customers to listen to what they like, what they want, what they don't like, I think really helped us shape what type of content we ultimately ended up airing. And so the type of feedback we got was we were a little too heavy on the fun and they wanted more trading. And so it was that shift where we ended up doing way more trading and just had the right flair of fun and entertainment, which really ended up just being real. I mean, we have a couple Second City comedians, but it wasn't the 5, 6, 7 we had in the beginning. It's more like 2.
Got to talk about Robinhood. You mentioned the firm before. When they came out, with the zero fee trades, was this a major threat? Did you see it as a threat?
Interesting. I'll tell you, our first reaction when Robinhood came out, while they had the same sort of philosophy around what we were trying to do with Doe, they came out with zero commissions. And we said, oh my gosh, they're never going to make it. You look at like Zecco. I don't know if you remember some of the different firms that came out with zero commissions. But anyway, so they came out and they had said, well, we're going to make money on payment for order flow. Yet they were offering, 1 share of stock at a time. We're like, you guys, do you understand how much money payment for order flow is on stock? It's minuscule. And so we certainly had no thought about them other than seeing their interface going, oh, conceptually, the way that they presented and designed and really made this simple for someone who really, truly doesn't understand trading or didn't know trading, they did a great job with the interface. So as they, over time, and they're bleeding cash for many, many years, when they finally understood that where the money is in options, that shift, it was worth sort of sitting up and listening and watching and actually giving them kudos for bringing on. Probably the biggest thing we give them kudos for is for really empowering this next generation in a different way that has opened the eyes of a lot of people that you don't need the millions of dollars. You don't need a finance degree. You don't need a lot of time to learn how to trade. You can trade a share of stock while you're standing in Starbucks, right?
Yeah. And did they supplement their revenue stream beyond payment for order flow or?
They absolutely did. They did a gold subscription. The thing that they have done well is they have continued to innovate and they have continued to add services. They added crypto. I mean, we added crypto too. There are different things that we were doing in some cases before them, in some cases, simultaneously, and everybody else in the industry was too. But what they did really well, and this is what a lot of West Coast firms do very well versus Midwest firms. The West Coast shouts from the top of the mountain of what they're building and what they're doing and marketing it really, really well versus Midwest firms put their head down, they build it, they don't even talk about it till they're done, and then they're trying to market it. And so it's this massive different philosophy in building businesses.
Even a media entity like tastytrade, there's no wiki page, like the Crunchbase and PitchBook is pretty lean. It's amazing how mysterious it was for so many years, prior to having a unicorn outcome.
I agree. I think too, over time, we realized that, first of all, it's a very niche business that we have, but you're exactly right. Like some of the basics around marketing and shouting and putting out there to the world what we're doing versus just focusing on building a sustainable, profitable company. And we were profitable early on. It's something that we focused on every single dollar spent versus spending our time out there marketing who we are, which you can argue which one's better.
Well, I know what I like. I mean, a lot of people have watched the strategy of our venture firm and they know how we kind of first built on media. But I look at the two companies and you both had a very clever way of filling top of funnel and acquiring customers. One was, we'll give you commission-free trades, give it away for free. Yours was creating a media entity, training these people up, educating them, and then they become much more sticky long-term customers that are probably much more connected to your brand. But to do what Robinhood did, you kind of have, loss leader type marketing, you have to have a pile of cash, and they did. So it worked.
They absolutely did. They raised a lot of money. They had great backers. Right. At the end of the day, they had a lot of additional deep pockets that they could reach into. So they did that well. I think the only thing and they still came out of this on top, but I think the one area where they faltered a little bit, but again, they rebounded from it, is when you started to really understand when they shifted from clearing through a third party to going self-clearing, and also really understanding the regulatory landscape, especially when they started talking about banking. This is where they sort of got out of their realm because they got slapped a few times. And to where we know that fine line you can't cross just because we've been around and been in this industry for decades. But, again, it didn't crush them. It wasn't something that ultimately put them under or anything like that. So they figured it out.
Kristi, what do you think they got wrong in the GameStop scenario? Do you think they deserve some blame here? And what did they get wrong?
I really don't think they deserve blame at all. I think when you take a step back and you look at the environment we're in, no matter what topic, no matter whether it's political, whether it's trading, we are in an environment like never before with this open ability to talk about anything and everything. And when you look at regulators are not prepared to monitor all of these different social media channels. So from the standpoint of if Robinhood didn't even exist, this still would have occurred because of all of the social media platforms. If the social media platforms didn't exist, would this have occurred in this same fashion? No. So you start to look at Robinhood. The only thing that they probably could have done better, it's more about transparency, is making sure you're transparent with your customers on what you can and can't do and what's actually happening in the market. Now we have a platform that allows us to talk about all those things and what's happening and give customers the context of what's going on. Robinhood and a number of other brokerage firms don't have that same platform. I shouldn't say, because they do have their media arm, but were they talking about it in a way that customers needed to hear and understand? I think too, the only other thing, and something we believe very strongly in, is education. And really, truly helping that customer understand risk as they jump into it. Mm-hmm. And I think that that's another area that maybe they could have done better. They did a fabulous job of bringing a lot of people to the table, but making sure they're educated on certain aspects, I think is the other thing that the whole industry can do better.
Kristi, as the high frequency trading firms and the big market makers emerged, they're often shaving gains from individual traders, or it's seen that way. Did this present any threats to the business? Did this adversely impact what you were trying to do? How did you view sort of the market makers? And I know in many cases they're partners. So
exactly, right. You talk about high frequency traders, and I think they ultimately get a bad rap. But at the end of the day, when you look at these market makers, they're providing liquidity. Right. They're providing the ability for the end customer, the everyday ordinary person who wants to be a self-directed investor, to be able to get in and out of their trade, get in and out of their position easily. And I think they get a bad rap because of the shaving, if you will, but it's not a bad thing. As a matter of fact, if they all went away, I think we would be in a much worse position when you look at the markets. That is one of the things that has come up multiple times with Gensler around payment for order flow, and wondering, should we get rid of payment for order flow? Well, in reality, we ultimately need all of those market makers. And the way that we can actually bring low or no commissions to the end customer is with brokers getting paid for payment for order flow. Yep. And as long as you have the right transparency, and as long as you have the right metrics around price improvement and quality of execution, and you have all of those things and you're sharing that with the customer so they can see that, it's a really efficient process. You take out payment for order flow. I mean, there will be another way of payment form that would develop, but right now, this is working. I feel like there's a little bit of a heavy focus in the wrong area. It's sort of like it's an easy thing to point to, and yet payment for order flow is not the problem. That's actually a solution that actually helps the end customer in the end.
Right. And like everything else in life, there's a fee for it. The last threat that I wanted to discuss, we've gone over a few potential ones to the business over the years, and there were a lot of powerful people in Chicago that may not have wanted to see things move online. Did this create any fear or any existential threats, either to Thinkorswim in the early days or tastytrade in the early years?
There were definitely a number of folks who didn't want to see this go see trading shift online. But Nick, there really was no way for them to ultimately block that or stop that. And so in the end, it was sort of like you needed to join forces or you would become a dinosaur. And so it evolved over time, and it wasn't without pushback from a number of people. Ultimately, we needed to move this direction. So they were done quietly, but it didn't make the waves that they were expecting.
That's right. You can't really fight progress, ultimately. Innovate or die. I'm curious, Kristi, was talent ever an issue for the business, having been located in the Midwest?
Great question. I would say that most firms that are seeking developers, particularly ones with any sort of talent in financial services, especially complex derivatives, they're few and far between. There's not a lot, but talent for developers with any board I'm on, with any company I'm involved in, any startup I invest in, that's like the number one problem is pulling in the best developer talent. So what do you got to do? You got to go to the universities and try to bring on some of that new blood, the new talent that's coming out of these universities. That is one of the things where Chicago is like the number 2 or number 3 producer of engineering students. So that is actually a huge plus to at least get, let's call it the entry level developers, and then shape them the way that you want them. But it's still a difficult sale to bring somebody in when you, especially in January, weather is below zero and everybody wants to go to the West Coast. But it is easier after a few years to pull them out of the West Coast, believe it or not, and bring them back to Chicago.
Well, and I know the tech companies are often pretty flexible about remote work and stuff, but some of the trading firms, the proper market makers, not so much.
Not so much. Nick, we had a philosophy in the beginning. We didn't want any remote workers. And even up until the pandemic, we really wanted people there. And trust me, it wasn't for people not saying, hey, I really would like to work from home. And can I have a few days work from home? And we would do that. The development team had their own sort of, let's say, schedule. But the pandemic hit and it was eye-opening. It was absolutely eye-opening and caused a lot of good, healthy conflict and debate internally, especially between me and Tom, about how productive everybody was. And in reality, I think a tremendous amount of productivity. People really got a lot done, and we could bring in more talent as well, because now we sort of opened this funnel by the more.
I take it your side of the debate was in favor of remote work.
I was in favor of remote work, but only after I've experienced it myself, because I too was in the office, I felt like 24/7 and it was, whatever. But being home, I saw how much more even I could get done and didn't have somebody walking in my office every 2 minutes. And it was great for that. But I'll give you the other side of the argument to that. And this is something I 100%, Tom and I totally agreed on, was the level of innovation and creativity. It was not there, not to the degree that sitting in the same room, or what we would call the big boy table. There was the big table in tastytrade, and we'd all sit there at lunch or pop in and eat or talk for a little while or talk about an idea. And the development of some of those creative ideas literally took place. People talk about water cooler talk, right? Ours was the lunch table talk. But it was that creativity and the innovation, the collaboration that you just didn't get talking on Zoom. You didn't get the same type of thing of overhearing somebody else saying something and then having the ability to add their 2 cents and having things roll from there. That's what I missed during the pandemic.
100%. Kristi, what do you think is next for crypto? We've seen this recent meltdown and the failure and the ethical issues over at FTX. What's next for the segment?
Crypto is a critical aspect of the finance industry and the future. And I think that with crypto in general being fairly new, it has still been the wild, wild west without, and you've probably heard that phrase or them put in that category before, but regulators are just catching up to crypto and what needs to happen and how it needs to be monitored and regulated. Crypto itself, digital currencies itself, blockchain itself, all of those things, those are here to stay and they're going to be transformational and have been transformational already. But we need the right regulation and the right transparency. But you go back decades and you're going to see the same thing around the financial markets, right? I mean, there has to be this development over time, but there definitely needs to be better regulation. But when you had the regulators fighting over who actually should be the oversight board on this, you're like, come on, guys, let's pull it together. So more regulation and transparency, as long as they don't swing the pendulum too far.
Do you think crypto recovers more quickly or more slowly than the rest of the market amidst this downturn?
At the end of the day, we don't really know what's going to happen. But in my opinion, I would say that crypto probably recovers faster because you look at the people that have invested in crypto and the volatility in crypto has been all over the place. And the newer generation traders are the ones investing in crypto more so than I'll say the old school self-directed investors, and they don't know what they don't know. I feel like they have more optimism around where this could go.
They love the volatility, right?
And they love it. We all love volatility. At least derivative traders do.
Kristi, if you had one piece of advice for outsider founders, those that are not building in the Bay Area and don't have the ideal tech resume, what advice would you give them?
And only one thing?
You're going to have to distill it down to one for us, Kristi.
Okay. So first of all, I'm going to say too, because I love the concept of just do it, jump in, go do it. But the other one is if you really want to build an authentic, sustainable, fabulous business and culture, leave your ego at the door.
A lot of current day investors, VC investors, to clarify, in Chicago and the Midwest at large, don't realize that sort of the founding investors were the traders. When I talked to a bunch of mentors in Chicago that kind of taught me the VC business, they often came from the pits and some of them moved on to online trading. But these were the original sort of folks that had the risk appetite, had some cash, and kind of kickstarted the Chicago ecosystem in the early Groupon, Grubhub, Braintree, Echo days. I'm curious, though, maybe this is the reason I don't want to answer my own question, but I was always curious why you did bootstrapping. Like, I loved bootstrapping in America. For the audience here, it's this program, a daily program where you'd interview some of the best entrepreneurs and in some cases investors. And I loved it. I've been on the show once. I was always curious why you did that because it's different than trading.
Bootstrapping in America was created sort of as our give back to the community. Being entrepreneurs ourselves, we had a platform to be able to share these stories. We had this online media company. And so early on, it was just set up as something fun for us, but also our give back to the community. So we've done over 2,000 interviews. Wow. And I personally, which is really crazy when I look back at it. But
I thought I had done a lot, Kristi, but you put me to shame.
Well, and I personally, so Tom did the first handful of years. So he
That's
did
right.
Sort of the first 1,000, and then I did the next 1,000.
Tony was there throughout, I think.
Tony was there throughout. And listen, Tony is the consummate comedian just by his nature. He's fun and keeps it light, and he's really a wonderful, wonderful co-host. But anyway, so we did this over that time frame. But the one thing I'll share with you about me is I looked forward to that every single day. It was this interaction where I had the ability to learn something new or confirm what I thought I already knew about entrepreneurship or building a company or whatever. And you just got the chance to meet a lot of great people like yourself. It was really fun. And only recently, with my exit from IG Group and Tasty, I now have handed it over to Dylan Radigan. So I don't know if you know Dylan from way back when.
I don't.
He was with MSNBC and CNBC, and he was a commentator, investigator, on TV around finance. So we sort of had brought him in over all these years after he left media. He's a really great host and co-host, but it was something, you're exactly right. It was not trading related, but it was about empowerment and sort of sharing. It was with our same foundation philosophy about empowerment through information.
Amazing that you're passing the mic on. And I want to get back to Tasty and Robinhood and some other items, but any salient takeaways or lessons you learned from interviewing all these great entrepreneurs?
Oh my gosh. Yeah, plenty. But the one resounding message, because a lot of times, I'd go through and at the end of the interviews, a lot of times I would ask, is there one piece of advice that you would give to somebody who wants to start a company? And a disproportionate amount of time, it was said, just do it. Like, don't overanalyze it. Don't overthink it. Like, jump in and you'll figure it out. And hands down, that resonated with me. First of all, I love Nike. And I literally, on my workout room at home, I have the words, just do it, on my wall. And so it is also a philosophy that I live by. So to hear that time and time again from multiple CEOs and founders really resonated. It's funny though, I'll share with you two other things. One is when we would have restaurants on and I'd ask them that same question, they'd say, don't do it.
Really?
Because the
restaurants are a tough
business, the margins are razor thin, and it's something that you're putting your whole self into. And so you just have to be prepared for that. So for whatever reason, the restaurant business, right, continually gave that answer. And then the other thing is when I had VCs or private equity firms on, I'd like to ask the question to them, are you investing in the founder or the idea? Like if you had to pick one,
sure,
what would that be? So let me pause first before I tell you tell your viewers, or your listeners what the answer is. What would you say? Do you guys invest based off of the idea or the founder?
Well, the cop-out answer is both, but we have a heavy bias for the founder.
Yeah. Yeah. And that is the resounding answer that I got. A few times I got idea, but a majority of the time it was the founder that you're investing in. Because it's just like, I think back to even when we created any of our businesses, it was, there wasn't a perfect plan, but you sort of have, if you have confidence in the founder, they'll figure it out and you can help them figure it out if you're investing in them.
Well, and to your point, like there are categories and there are asset classes and there are segments that don't lend themselves well to returns and multiples and margins, right? And so if an investor is doing their job, they're probably pre-filtering and deciding what areas and categories and markets to invest into. And then when the best founders show up, it can be a slam dunk. Love it. Kristi, do you have any habits, tactics, or techniques that are a secret weapon?
That's a good question. I would say being genuine and transparent is probably one of the most valuable tools throughout my whole career and has sort of helped open doors and has gotten me invited to the table a number of times, is just having a genuineness and authenticity there's no hidden agenda. You're going to know why I'm here and what I'm doing.
Amazing. And then finally here, Kristi, what's the best way for listeners to connect with you and follow along with your efforts?
Yeah, absolutely. Well, you can follow me on Twitter at Kristi Ross X. And certainly I would say that even though I am no longer with Tasty Trade, I mean, it is my family and people should go check out tastytrade.com and watch Tom and Tony and really learn more about the trading industry.
Well, folks, she is Kristi Ross, one of the top entrepreneurs and founders in all the country. This has been a sincere pleasure for me to do this, Kristi. I've hoped to do this for many years. Congrats on all the success. And hopefully before next time we have you on the show, we'll have Nike as a sponsor and we'll all just do it.
Thank you so much for having me, Nick.
Thank you, Kristi.
All right, that'll wrap up today's interview. If you enjoyed the episode or a previous one, let the guest know about it. Share your thoughts on social or shoot them an email. Let them know what particularly resonated with you. I can't tell you how much I appreciate that some of the smartest folks in venture are willing to take the time and share their insights with us. If you feel the same, a compliment goes a long way. Okay, that's a wrap for today. Until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks so much for listening.